Hello, this is Ruban Selvanayagam and welcome to another Property Solvers podcast. I'm very pleased to have Simon Misiewicz from Optimise Accountants on today. How are you doing, Simon?
I am very good, Ruben, and thank you ever so much for having me on your show.
Great stuff. So I was thinking about when we first actually started working with each other and realised that it was back in 2015, which was coincidentally when Section 24 was first announced. And that's what we're going to be talking about today. So just a quick legal disclaimer. This podcast is not intended to constitute financial or tax advice and therefore should not be relied upon. Before making any decisions regarding how to best proceed, we would suggest you seek professional advice from a qualified tax advisor and or accountant. So Simon, along with his wife Louise, head up Optimise Accountants and have been helping many landlords, including myself, over the last 9 years or so, navigate through what's been quite a seismic change in the buy-to-let taxation space. So we've titled this podcast, The Ongoing Effects of Section 24. So perhaps a good starting point for those that may not be aware of it. Perhaps you can start by outlining what Section 24 is, Simon.
Of course. And it's not a nice thing to talk about, let's be honest. So Section 24, or Mortgage Interest Relief Cap, as it is better known, is a restriction of tax relief on the mortgage interest that you pay out. So, and that's in your personal name. So I need to make sure that we're clear that Section 24 affects individuals, but it does not affect limited companies. So on that point though, if you are an owner, individual owner of buy-to-let properties, which are residential, again, then you may have an income, you'll have expenses, and before Section 24 would come into effect, you would have the net profit position and you would pay tax on that net profit. But now, because of Section 24 mortgage interest relief cap on residential properties, you would have a rental income, you would have less the direct costs of letting agents, repairs, maintenance, utilities, etc. Mm-hmm. That would give you a gross profit number. Mm-hmm. And I say gross profit because HMRC will tax you on that number. And you'll notice I've not mentioned mortgage interest costs, and that's because the tax calculation ignores it. Okay. So what they do instead is as a high rate taxpayer, you would pay 40% on that gross profit number, and then you would get a 20% tax reducer based on the mortgage interest costs that you have paid out. So It means you have less tax relief as high rate taxpayers and additional rate taxpayers.
So it's almost a kind of credit that the HMRC give you.
That is correct, yeah.
Yeah, okay. So 2021 was the first year that no residential mortgage interest costs were fully tax deductible because it was kind of phased in over 4 years, I believe it was. So yeah, I mean, it's definitely had an impact on the market because it means that, you know, particularly if you're a higher rate taxpayer, you're going to be hugely affected by this if your mortgage debt is quite high. So what difference does it make by being a basic rate taxpayer? Does that make, is it a huge difference between being the two different?
Many people say no. Whenever you speak to 10 accountants, you'll always get invariably more than 5 answers.
Right.
So when people say, does it affect basic rate taxpayers? The simple answer would be no. And let me explain why I say simple answer. If you are a basic rate taxpayer, you pay 20% tax. Mm-hmm. The mortgage interest relief that I talked about, the tax credit, is 20% as well. So you would say, well, I had 20%, I've still got 20%, so I haven't really lost out. I'll still get 20% tax deduction on my mortgage interest costs. So what's the problem? Mm-hmm. Well, the problem really starts to begin with is where you have mortgage interest. Let's imagine that you had £50,000 of gross profit I talked about, and you had £20,000 worth of mortgage interest. then you would have a £30,000 profit. Now that £30,000 profit in the olden days, when you've got mortgage interest costs in there, you would be a basic rate taxpayer, not a problem. But now if we have to ignore it, the mortgage interest, you've actually got £50,000 profit, not 30. So you could easily be transferred from being a basic rate taxpayer to a high rate taxpayer, if not additional rate taxpayer, by ignoring mortgage interest. So it's not as simple as saying, well, I had 20% tax relief, I still have 20% tax relief, doesn't affect me. It could, based on your individual circumstances when you calculate all your numbers through.
Yeah, and especially in recent years, as landlords have increased rents in response to this, your overall revenue from the rental income is going to be increasing as well. So the chances of that going up in terms of what your gross rental revenue is going to be, the chance of an increase is going to be a lot higher, So I think that's what's happened to quite a few landlords in response to Section 24. They thought, right, I can just increase my rents, but then you're kind of pushing yourself into that higher tax bracket. And I think a lot of landlords as well, most of us want to be in the higher tax bracket anyway. That's the whole reason people get into property, really, to supplement their income or earn more money from it. So a lot of landlords kind of move into that. But then you've also got a lot of landlords that have own their properties unencumbered. That they may have a low level of mortgage debt, in which case they're not as affected by Section 24 because they don't have to worry about these mortgage interest costs that they're not able to offset anyway. So I mean, in your personal opinion, Simon, why do you think Section 24 was introduced? I mean, without getting too political or conspiracy.
I think that's a difficult question not to be political. George Osborne, that brought this into play, his agenda was to free up housing. That was the main thrust of it.
Yeah.
It wasn't an attack on landlords from a tax perspective, but it was an attack on landlords to give up their properties to ease the housing situation that we had, to put houses back in the hands of the people that live there.
First-time buyers.
So I'm not going to go any more than that, in all honesty. Yeah. Whether it served its purpose or not, I'll leave the audience to ponder that thought.
Yeah, it's a difficult one because it made sense at the time, because back in 2015 when it was first introduced, the buy-to-let market was going through quite a boom period. It was quite easy to get into the market, go and buy a property at auction, and just take on a tenant. Rents were still quite healthy. The market was very buoyant. I think as it's become introduced, obviously it has had that desired effect. But the problem is that from what I see, the rents have gone up to quite a high level. There's a lack of supply because a lot of landlords have sold up, which I think we're going to be talking about shortly. And it's just led to a market which is not particularly healthy, because there's a distinct lack of rental properties out there at the moment, because a lot of landlords have been selling up as a result of this, and my personal opinion is that it's not going to get reversed. I know there have been attempts over the years to challenge Section 24. One was actually Cherie Blair. She lost the legal challenge, I think it was 2016. So maybe her husband's influence over the Labour Party could bring it back to the forefront, but I probably wouldn't be putting too much money on it if I was a betting man. But I think the chances of it getting reversed are pretty slim. So it's just something that we have to live with moving forward. So as an accountancy practice, when you would have a general assessment on each landlord that you're working with, but what has been your general advice? Has it been to kind of sell properties, or what's been the kind of general feedback that you've been giving to landlords over the years?
My view is, I think there's definitely a focus around taxation, and for me, recent times there's been another challenge, which is mortgage interest increases. So not only have you had this issue of tax pressures, but you've also had this increase of mortgage interest costs, which to a point that a lot of our clients are now facing that HMRC and the banks seem to be making more money than they do.
Yeah.
And that's a tough one. So whenever I speak to clients or my accounts managers speak to their clients, the focus point isn't just taxation. It is looking at their portfolios and say, well, which properties make you money, which ones don't. Rather than refinancing, why not pay off some of your debt? Because if banks are making more money than you do, then why pay out the greater interest costs?
Mm.
And then from a tax perspective, it is that old adage of looking at your property portfolio and get rid of your dogs and keep your stars.
Mm-hmm.
And then your tax position should ease over time as you make more money through property. So it's never an easy answer to say one answer fits all, never does. But one thing I would say to a lot of landlords listening to this is you need to look strategically at your portfolio. You also need to sit or Zoom call with your accountants to go through your portfolio as a whole and not just your tax return, because the devil is in the detail. And it's only until you do a thorough review will you truly understand what you need to do.
Yeah, yeah. So in terms of remortgaging, that's become really difficult for personal property owners because it's effectively become pretty much impossible because most lenders are looking at the portfolios and kind of saying to themselves, well, you're quite exposed to Section 24 here, so you're not going to be able to refinance here, which has kind of led more people to kind of think to themselves, okay, well, I'm going to have to sell up here. One good thing is that if they bought their properties perhaps not long after the financial crisis or in the kind of 2010s, they probably would have accumulated quite a lot of equity in the property, in which case they could sell up. Yet there would be a capital gains liability, but it means that they can sell up and then perhaps, as you suggest, Simon, reduce some of the secured debt against the rest of their portfolio, sell the dogs, as you quoted nicely there, or start building up properties in a limited company structure, which is a lot more efficient. And I think that's just the way buy-to-let is done nowadays, right? So yeah. Were there any other strategies that you think would work quite well for people who perhaps are still quite exposed to Section 24?
Yeah, so I think there's a couple of strategies that we spoke through with our clients. You mentioned one already, which was to invest inside of a limited company, simply because Section 24 mortgage interest relief cap does not affect limited companies. So you won't have that tax trap to worry about. So limited companies is definitely the focus point now when we're speaking to investors. The other one that we used to talk about was to convert your residential buy-to-let into a serviced accommodation or furnished holiday let. Clearly, the most recent tax changes, which will come into effect next April 2025, where you do not get the same tax benefits that you used to for furnished holiday let serviced accommodation. So those particular investors that have furnished holiday let service accommodation will also be affected by Section 24. So you now have to worry about your portfolio with those added in to see what tax implications you're having. And this is where, again, conversations needs to be had to say, well, where do you make the most money? There are many different types of properties you can own. You can have a single let, you can have a HMO, you can have a service accommodation. And really now you have an equal playing ground regards to tax planning. But what you should still be doing is looking at your assets and sweating them as much as possible and say, well, which strategy works for my portfolio, if any? The fourth option could be just purely sell that property.
Yeah.
So there definitely needs to be holistic planning. If one thing I would say about landlords, property investors, is the lack of planning that I see.
Mhm.
And I'm not just talking about clients, I'm talking about whenever I'm doing ad hoc tax consultations with people. And I'm talking about their relationships with their accountants because they want a second opinion from me. And one of the things I say is, well, when's the last time you did a spreadsheet that shows all your properties, shows the rental income, shows all the individual costs, shows the profit line,
Mhm.
shows the return on investment after you have paid your tax bill for each of those properties? And most people, I would say 9 out of 10 people, haven't done that.
Yeah.
And I think, in all honesty, if there is any one takeaway, it's not the big picture of this silver bullet will solve your tax problems. It's actually sit down and go through your investment portfolio like a professional and then start to look at your assets as a whole. And once you've done that, you may have some solutions which you've never thought about before.
Yeah, and these days it's a lot easier to do that. Most of us are using QuickBooks or Xero, and you can, track all of those figures quite easily these days. And it's fairly simple to kind of put that all into a spreadsheet and, take a bird's eye view of the portfolio and just kind of think about what your next steps are, look at your tax positions. There's some areas in the country where we've been involved with where the capital values haven't gone up that much, so it's quite hard to even think about selling. But then maybe you could benefit from the higher yields you often get in those areas, increase your rents, and maybe sell off a few and just kind of balance out the whole portfolio to make it a lot more efficient. So yeah, that's definitely a good point. And what are your thoughts on incorporation? I know I'll steer clear of some of the schemes that have been flying around since Section 24, because I know a few of them are probably going to be under investigation by the HMRC. But if we were going to just say, right, I'm going to say, for example, a landlord was thinking of just incorporating their property portfolio, i.e., moving it into a limited company. Obviously, the two taxes that that you would be liable for would be capital gains and stamp duty. Is that right? I mean, what are your thoughts on that? Is it, again, another case of just kind of taking a high level view and seeing if it's actually worthwhile doing it?
Yes, and let's outline that, because if you're looking to sell a property from your own name into a limited company, you do pick up capital gains tax on the gain of the property you've had. So what you have to look at there is, well, what is the market value of the property now versus what did I buy it at? And that is your gain. So you have to take the genuine market value as of today's date when you want to move it to a company.
Sorry, Simon, just to interrupt there. Would that be would you have to get a RIC survey? How would you ascertain what the market value is?
Yes, that's a great point. So I would always say get a RICS valuation done. And there's lots of people out there that would say, but my estate agent has given me a valuation, can I not accept that?
Mhm.
And the answer to that will be they're not professional.
Yeah.
And I don't mean to slate them in terms of their professionalism from a estate agent perspective, but they're not a true bricks and mortar valuation specialist.
Mhm.
And HMRC know that. And they also know that estate agents are a lot more flexible. They have no professional obligation to go through the right protocols to value a property. They just don't. So HMRC do require some sort of thorough research done by a RICS surveyor or someone equivalent to that.
Mhm.
So, and that market value not only represents your gain, which is capital gains tax liability, but it also represents the tax charge for stamp duty land tax. So you've got the banded rate of stamp duty land tax, and you've also got the 3% SDLT high rate to pay as well. So there's two bands there. Yeah. So it's whenever I speak to people that's looking to incorporate their property portfolios into a company, and you're right, I think for today's session, it's probably better to try and ignore the incorporation relief issues, simply because HMRC are not being open about their thought process around incorporation relief going forward. So I think whatever I say now would be wrong, no matter what I say. So I think for incorporation relief, we have to ignore, for the purpose of this show, until maybe 2-3 years down the line. I think HMRC will generally take that long to work out what they've got to do. So it does leave people with that exposure of capital gains tax and stamp duty land tax. Now, the one thing I would say about that, and it was an interesting comment you made about people that have properties that haven't increased in value. Well, if that's the case, you have no capital gains tax issues. And if you was buying properties in Manchester, Liverpool, Hull, Leeds, that kind of way, Doncaster even, then the value of the properties may not be substantially high. So if you've got a low capital gains tax and you've got a property of, let's say, £150,000, so you may only pay 3% on that £150,000. Is that worth moving to a limited company? I think it would be. So I definitely think, again, whenever I'm speaking to people, it is about their specific case, their property portfolio, their tax position, and then establishing, well, how long would it take you to, what's a payback period? And what I mean by that is, well, how long would it take to get the tax benefits of using a limited company versus what I've already paid out to move the property into a company?
Yeah.
And most times whenever I'm doing a payback, it's typically about 3, 4, maybe 5 years. Now, if I do analysis for someone and the payback is more than 10 years, then I would straight away say incorporation for you is not right. You need to think about disposing of that asset or converting it into something else. And I do see people, unfortunately, blindly trying to incorporate properties into a limited company, and then later on down the line find out, well, actually it cost me more than the benefit I've got.
Yeah.
And that's because probably they haven't sat down with someone to go through that thoroughly like they should have done.
Yeah. And the whole issue of incorporation relief, there's the Moyne versus Ramsey case. I guess that doesn't apply to the majority of landlords, because I think it requires, was it 14 hours of kind of intense or hands-on involvement per week in the property portfolio. So most people wouldn't have that available to them. Is that right?
Yeah, let me just clarify a couple of points here. So the Ramsey case, I think it's 2013, the court case went through, was talking about a couple that had a property and they spent a lot of time with the tenants, as in they used to chase a tenant for payments, they used to do the maintenance of the property, they would go and see them, they would go inspect the property on a regular basis, and they amounted their time as 20 hours per week. Now, I'm not sure how they substantiated 20 hours, but one thing to bear in mind, anyone listening to this, is that court cases is qualitative, not quantitative. And so what I mean by that is you need to think about, even if you do 20 hours, are you covered by the Ramsey case for incorporation relief? And the answer could be no. The judge could look at what you do and say, well, actually, we don't agree with your amount of 20 hours or 25, 30 hours or whatever you've come up with. We don't agree that you could have spent that time. So it's not the case of, oh, well, one person got through, therefore everyone else can follow. Actually, you've got to look at your case and why you think incorporation relief would be justified. Now, as I mentioned just a few moments ago, that the notion of incorporation relief, and the Ramsey case was all about, I'm moving my properties into a limited company, I'm claiming incorporation relief, which means I do not need to pay stamp duty land tax, nor do I need to pay capital gains tax. Well, those incorporation relief matters are being scrutinized by HMRC currently, to a point that they not only do not give opinion of you proactively seeking their advice, they're not doing that at all. what they're waiting for is for you to incorporate and then say, we disagree with you, and then throw a hefty tax charge. A few of my clients are going through this now where they have incorporated their properties into a limited company and now being investigated by HMRC to say we're challenging the whole notion of incorporation relief.
Wow.
HMRC are not, and let me re-emphasize the word not, giving any grounds for their opinions of why they are investigating this or what their opinions might be in the future. Will they accept incorporation relief, or will they change legislation now to ensure that no one can incorporate properties in the future? There is a lot of grey areas right now, great deal of uncertainty. And when anyone is asking me, can I think about incorporating my property portfolio? My answer right now is no, you shouldn't be thinking about it, because HMRC don't even know what they're going to be doing about it in the future.
Wow, interesting. And this is kind of come to pass in recent years, right? This whole kind of detailed investigations that HMRC are conducting is only seems to be the last couple of years that they seem to be stepping up in terms of doing these investigations into what's been going on. Is that right?
That is fair to say, but let's be right about this. Landlords using limited companies is also a recent trend.
Yeah.
So why would HMRC investigate such a matter 5-10 years ago when the volume wasn't there? The volume is now there, where people are using limited companies to buy buy-to-let properties and so on, and people wanting to incorporate properties into a limited company. That is a recent trend. It's not something that's been there for decades gone by. So HMRC are now picking this up and saying, well, hold on, I know we have legislation in place to allow incorporation, but this is such volume, bearing in mind the financial crisis that the country is in, is there an opportunity? And they're not saying that they're looking at this from a business perspective, but they are obviously seeing this trend and saying, where's the opportunity for us?
Right, interesting. So it would seem like the cleanest way of doing it is to effectively sell any properties that aren't giving you the results you need, like you're paying hefty tax bills on them, sell and then build it up cleanly within a limited company. Would you agree with that in terms of building up almost like a fresh portfolio, as lowly geared as you can? And then just kind of manage the portfolio for your limited company. Would that be, or various SPVs if that's what you choose to do? Would you
Of course.
the best way forward in terms of what you would generally recommend?
Yeah, so the one thing I would say about this, and please don't say take what I'm saying as gospel as the only advice you should take. But let me just go through some of the observations I've made in the last 20 years of doing this. My take of buy-to-let property investing is that you would need to look at your investments as a whole on a regular basis. If you're not looking at your cash flow, your balance sheet, and regularly going through it and saying, am I making the right return on my investments? Yes or no? Then you wouldn't continue. You would be fired, right? If you, as an employer, and one of your employees were making really strange decisions with your money, you would say, well, hold on a minute, why are you doing this? And your job security is not really there. But you need to do that as an investor. You need to take this a lot more seriously, especially now. It's not easy to make money. So I understand that people are frustrated with the position. But what I would say to a lot of people is that we've had it good for many years. Interest rates being low, tax being relatively low compared to a lot of countries. I live in Spain and I know full well that European countries pay more tax than the UK.
Yeah.
So we have to bear in mind that things have changed. But the landscape of investing hasn't really changed at all. It's, I'm going to place my money in this investment. I expect a return. And if I don't get it, I simply change the investment structure or the type of investment I might make.
Yeah.
So for me, this is a great opportunity actually to look at what you've got, to look at what you're buying, and to make decisions to say, well, this is my position now. I want to go from this position to a more lucrative one. How do I get there? What type of investments do I currently have, and what do I need to go for forwards?
Mm.
So I do think there's a lot of challenges, but I think those challenges are more opportunities that need to be seized. And it's probably never been required before because we've had it so good. Let's be fair,
Yeah.
interest rates being at 0%, that was never realistic.
Yeah.
So that's always going to change, and it just now has. And we just need to now change. We change with the times that we are faced with, and we make money just as we have before.
Yeah, I totally agree with that, Simon. I mean, also try and anticipate what your future tax obligations are going to be when even if you're buying in a limited company, which is what I think we're both recommending here. Understand that you're still going to have income tax if you're withdrawing money as an income, or dividends tax and corporation tax and all these other obligations that you need to deal with. So you need to kind of future proof your property portfolio, even within a limited company, and bear in mind that, just to go back to the Labour government again, I think there's a general feeling that they just don't like landlords. So we just need to be prepared for that, and I think taxation is one of the main ways that they can do that. They can kind of come back to landlords and really kind of not penalize us. I'm trying to think of a better word, but it's more just kind of this is what's going to happen. It's not going to be an easy, at least the next 5 years are not going to be easy under Labour. So I think landlords need to be prepared that your tax bills are going to go up, regardless of whether you're facing issues with Section 24 or not.
May I just step in though, Ruben?
Yeah,
because
of course.
I do see, as British people, we are notorious of seeing a position and making bad of it. But the one thing I would say is that whilst these changes are coming afoot, there are going to be a lot less landlords there.
True.
Now, the people requiring rental properties is actually going to increase. And why do I say that? I think that the interest rates has meant that home buyers have found it tough to even get a mortgage, never mind pay the interest. There is certain instability in regards to the employment market. Unemployment has gone up now to 4%, I believe. And therefore, people still need to rent properties. If there's still the demand, if not in more demand for rental properties, and there's less landlords, then surely there is an opportunity to increase rents. And I've been doing analysis now of rent increases for the last 36 months, and rents have notoriously gone up month in, month out, without doubt.
Yeah, it's shocking.
So there's opportunities.
Yeah, for sure. It's really surprising how much they've increased, particularly since COVID, I think. And as the cost of living crisis have kind of has played out as well. It's we've seen rents in certain areas of the East Midlands, for example, almost double in the space of like 2 or 3 years. Because the supply is simply not there, because so many landlords are exiting the sector. And as you say, there's all these kind of factors that have come into play that have meant that it's a lot harder to be a landlord. But yeah, on the plus side, that has meant that rents have gone up, and I think there are probably more opportunities because a lot of landlords have been selling up, and a lot of them are willing to take a little bit of a hit on the price as well, because they're seeing that there is a bit of a there's a lot of landlords that are selling up as well, so there's a bit of competition out there. That's interesting. So Simon, yeah, so you primarily work with in the buy-to-let space, or do you work in other areas as well at Optimise?
We focus on property. Generally speaking, property investments is where we've always been for the last 20 years, in all honesty.
Right.
So, and that could come up in terms of commercial property or residential property, the property development. So it's been centered around that for sure.
Okay, brilliant. And how can people find out more about what you do at Optimise? I know you guys have a really good YouTube channel, which I definitely recommend listeners
Yes.
tune into. How will people get in touch with you if they want to find out more about your services and more about what you do at Optimise?
The best way is to go onto YouTube and to just watch those videos from Optimise Accountants. Watch a few of those videos to understand the approach that we take, the advice we give, to get comfort and confidence in what we are doing for you potentially in the future. And once you've established that trust and willingness to work with us, you then head off to our website, www.optimizeaccountants.co.uk, and then book a sales call with Leanne, who is our customer service manager, and then she will talk you through our services.
Brilliant. That's great. And is there anything else you wanted to add to the conversation? I think we've covered quite a lot of ground here in quite a short space of time. It's I think it's quite a wide area, section 24. But yeah, if there's anything you wanted to add or any resources you wanted to refer us to apart from your YouTube video.
I think in terms of even if you're not working with Optimise Accountants, please do work with your accountants, generally speaking. There is the old adage, I want my accountant to be proactive. And that is true to a certain degree, but I think the proactive approach has to be two-way. So reaching out to your accountant to say, I want to have a holistic strategic review of my tax position, my property portfolio. How do I go about doing that? And if your accountant's worth their salt, they will help you. So I think it's now a good opportunity for you to take away all the things Ruben and I have spoken about today and take those forward with your accountant. Even if you're not with Optimise Accountants, work with your current one and make the most of their abilities, their competencies, their skill sets to help you in the future. And that is my biggest takeaway from today's session from my side.
Brilliant. That's great, Simon. So yeah, thanks a lot for your time. Always a pleasure speaking to you and really appreciate it. And yeah, I definitely recommend people who haven't got a good accountant to contact Simon and his team. We've had a really good experience with them over the years. So yeah, definitely recommend it. So yeah, thanks very much, Simon. And yeah, we'll catch up soon.
Thank you and good luck to everyone.